Hope you're well. I'm here with my good buddy, Brien Lundin. Brien, thanks for coming on the show. You got an incredible event coming up. We'll talk about that in a bit, but you are an expert in the gold space, and we talk about gold quite a bit on this channel. Maybe a different view from most, but I'd love to start off by getting your overall macro take on gold and gold miners heading into what could be a recession.
Yeah, thanks, George. It's always a pleasure to talk with you, and thanks for having me on today. Yeah, I think gold has, well, first off, it's been declining over the past week or so, which has kind of run counter to my forecast and predictions. A few weeks before that, was boldly claiming that gold had bottomed for the summer. Looks like it's putting in a double bottom. But the larger theme that I've been proposing is that the markets are starting to price in the very essential fact that this rate hike cycle is essentially peaked. You know, we might have another quarter point ahead of us, a little bit more. We might have higher for longer if the Fed gets its way. But the next big thing is going to be the downside of the interest rate cycle. And for whatever reason, we really don't know. We can speculate, we can play probabilities and possibilities. Nobody knows what's going to do it, but we know that something's going to happen, either a recession, which seems pretty apparent, but a very steep recession, or something else breaking in the financial system as we transition from the easiest monetary policy in human history to one of the harshest tightening cycles ever seen. Something's going to break, probably a few things. So we don't know what it is, but we do know, and the markets, I think, are starting to price in the fact that the Fed's next big thing is to start cutting rates in reaction to something. And gold right now, and other, monetary aggregates like silver and the mining stocks and Bitcoin, they're where you are going to want to be going into whatever lies ahead.
How does gold usually react just before a recession, though? I saw a chart. I think Jesse Felder put it up the other day on Twitter. Really cool. What they did is they went back to 1973, and which they could have gone back farther. I wish they would have, but they just went back to 1973 and they analyzed every single recession that we've had. But the starting point was when the central planners say, okay, it's official, we had a recession, and then they give you that specific date. Oh, Josh might be pulling it up. Okay, here we go. Yeah. And so, and as you know, they always state this in the rearview mirror. It's always like 6 or 9 months later. They say, oh yeah, by the way, a recession started 6 months ago. But they're using that as a 0.0, or their middle line right there, that dotted line. And what's really cool is they look at 150 days prior. That's on the far left. And then they go out, let's say 135 days after the recession is officially announced, right? And so if you look at gold, and you pretty much look at everything, it goes up until we get to about, like a couple months prior to that recession. Then it goes down slightly. And then once the stuff hits the fan, if you will, it's usually, I think, and I'd like to get your take on this, the government's response, which takes gold to its next wave up, whether it's fiscal, whether it's monetary. I mean, the GFC was just a perfect example of that. And if I'm not mistaken, I think gold goes down, not because the retail investor doesn't want to own it, but these big pools of money, they have to have liquidity. And it's the only, because it is the safe asset, it's the only thing on their balance sheet that has a bid. So that they got to sell it. And then then again, you get the recession, then the monetary and fiscal response, everyone looks at gold and is like, wow, now we really got to buy it. And that's what really makes it shoot higher. Is this consistent with what you've seen throughout your career?
Yeah, it absolutely is. And I think you hit the nail on the head. The last 2 recessions we had were basically unveiled through liquidity crises. Great financial crisis, which did have some warning, but then we had that just drop out when, you couldn't sell. There was nothing to sell for that could get a bid to meet margin calls except gold.
Right.
But everything everything was completely distrusted. Everything dropped in a liquidity vacuum. Same thing happened post-COVID. But then the policy prescription becomes apparent. You know what the Fed is going to do. And it's going to have to do something much more than it did before. That they did that in the great financial crisis. They did that in COVID. They multiplied everything, all their efforts. So that is what brings the money into gold, because investors are looking at those repercussions. What's going to happen with this great liquidity injection? And all of what we're seeing right now is really the end game of a 40 to really 60-year trend of ever easier money, not just easy money, but ever easier money, where the response to every little hiccup in the economy is to lower rates. And then when lowering rates wasn't enough, you lowered rates to zero. And then when that wasn't enough, you started injecting monetary adrenaline directly into the veins of the economy in COVID. So we know that, there may be a liquidity crunch. And if you're nimble enough, you may be able to buy gold at really bargain prices for a day or maybe a few hours. But when the policy prescription becomes obvious, when you know that the Fed's about to step in, that's when it's going to start taking off again. Because in the next event, they're going to have to do a whole lot more than they did even post-COVID just to get the same reaction from these, these addicted markets.
Yeah, let me go over what I'm doing with my own personal portfolio. I'll be a little selfish here with my questions.
Off your book.
and then I think a lot of people can relate to this, and just kind of give me your take on it. So I believe that you should always have a position in gold, always, regardless of the price, because I don't really see it as a way to get rich, but I see it as a way to just maintain your wealth. It's like an insurance policy. It's always how I look at gold. So for me, that's like 10% or so. But I think where you make a lot of money, and our good buddy Doug Casey and I think Rick Rule would fall into this category, is the miners.
Yeah.
Those are the ones, when gold goes up by, let's say, 20%, the miners, correct me if I'm wrong, they go up by 100% or 200%, something like that, maybe the junior miners. And that's where you really make money. So I like holding that 10% position in gold just always and just forgetting about it. And then when I think gold is cheap and I want to express that bet, then what I'll do is look at the other, what I call the speculative side of my portfolio, which just means I think there's good asymmetry. But I'll focus more specifically on the gold miners and trying to buy them. Let's say we do have a recession and we do have a little bit of a dip or something like that. You don't sell or you don't add your gold position, but you maybe look for gold miners on the cheap. And that's when you ride that next wave, which we saw in that chart, after the monetary and the fiscal, it just zooms higher. What do you think of that strategy?
Yeah, that's exactly what you do. When I talk to people who are new to the sector and wondering what to do, I tell them there are two reasons to buy gold: insurance and investment. On the insurance end, you're insuring against an inevitability. It's not something that might happen, like your home catching on fire. It's something is going to happen. In 3 years, 5 years, the purchasing power of the dollar is going to be significantly less than it is today. And gold guards against that over great periods of time. So you need to have that done. Buy physical metals, put them away, always own them. If you see the macro picture favoring much higher gold prices relative to the dollar and fiat currencies, and if you look around you pretty much, it's easy to come to that conclusion right now. Then you look for ways to leverage that macro trend, and that's where you get into the investment end of it. Now, these days you can leverage gold. You can do the Nugget 2X ETF. You can buy the ETFs on margin, et cetera. But the real torque, the real juice comes from these mining stocks that typically dramatically outperform the metals. And that alone is a wide spectrum from majors down to junior exploration. And you can do that. In some of these, in the junior exploration, tend to outperform even if the metals aren't moving, because they are based largely on discovery. What's interesting now is that the mining stocks relative to the gold price are about the cheapest they've ever been in recorded history, since gold was a freely trading asset. People ask me, have you ever seen the mining stocks as bombed out as they are now? And I say, yeah, 1999, 2000, that double bottom, It was pretty bad back then. Gold was trading at bottom at $252 an ounce. Today, we're within 6 or 7% of an all-time high, yet the mining stocks are really at just absolute rock bottom prices right now.
Why
So
is that? Because their input costs are so high due to inflation and the price of energy?
a bit, but not as much as you would think. That has happened before in 2009 to 2011 after the GFC. The oil went to $140 a barrel, and that really compressed the margins of the miners because it takes a lot of fuel to keep those big yellow trucks moving. Right now, not so much. They still have pretty healthy margins, although they have compressed a bit. It's really a matter of too many alternatives out there, and the fact that gold has not established a clear uptrend. And that's all we need right now to really get this is a consistent uptrend, because markets don't care where the price of a commodity is. They care about where it's going. And we have not yet burst through that kind of triple top we've had around 2050, 2060 an ounce. Once that happens, I think you're just going to see an absolute flood into the market. And I think that's very likely to happen this year or early next year. It's not that far off.
Wow. Okay. So that's Josh. Keep a note of that. It's definitely something we have to put on the watch list for sure. I've got a model portfolio with my subscription service, so I'm always, whenever I hear an idea, I always tell Josh to write it down so I don't forget.
I need a Josh.
Yeah. Yeah. So, how does silver compare? I was talking to Kiyosaki the other day.
Mm-hmm.
And I haven't been following the gold price, or excuse me, the silver price much at all, because there's so much going on with macro. But he said something that it's under 25 right now, and I thought that kind of surprised me. I'm like, wow, it seems to me it should be a lot higher than that, even considering the price of gold.
Yeah, it has, and actually, it's been capped at around $25 in its recent runs, and is a bit below that right now. It's been suffering along with gold. I tell people, if you like gold, and you should, then you should love silver, because in a extended bull market for gold, which is always a bull market that's based on monetary issues, real concerns about the future purchasing power of fiat currencies. In that kind of environment, silver has always significantly outperformed gold, and I think it will again. So, so you ask then, well, why not just buy all silver and no gold? That's because I don't recommend that. I think you need to have positions in both and allocated to both, because in the bigger picture, there's a very real likelihood, if not probability, that we're going to have the so-called Great Reset, when after successive crises, the central banks create so much fiat currency that it loses any credibility. And in that environment, the only real way you can reestablish credibility would be to connect those currencies to some standard that acts as a governor on these baser human instincts of overspending. And that is going to be gold. And I don't know that if we come to that Great Reset point, that the powers that be are going to throw silver into that mix. I think it's a near certainty that they're going to include gold as a prominent part of that mix, if not the only element in that mix. But I don't know that they're going to throw silver in it either. And one of the reasons is because silver has industrial usages. If you're going to attach currencies to a standard, then in the case of gold, you're going to have to multiply its price by about 4 or 5 times over. Gold's the only commodity, the only element out there that you can multiply its price 4 or 5 times over and not upset any industry in the world. I mean, jewelers can cope by just debasing the carat fineness of their jewelry, or raising their prices. But other than that, there's no other industry where that would affect prices significantly. So that's why, as Kiyosaki says, gold is God's money. It's the ultimate money, because it doesn't have it's not fit for any other real usage in any great quantities.
That's it. I never thought of that dynamic. And do you think why silver is trading at such a discount, because of maybe silver is predicting a recession due to its discount to gold because of that industrial component.
Yeah, that industrial component acts against silver more than it helps it. I think that the vast majority of silver's value today is due to its monetary history, not its industrial usage. If it was based on industrial value, it may be $5 or $6 an
Like
ounce.
copper or something.
Yeah, exactly. More valuable than copper, but not quite where it is today. So the industrial usage angle on silver is more of a stick to beat it with than anything else, I think, because when there is some kind of when there's negative economic news coming out of China, or some signs of a recession, then the traders jump on silver unduly, I think. Because it doesn't matter that much, it doesn't affect the supply demand, and the demand for silver as an industrial metal is really not that great at this point on the total supply demand dynamic. So, yeah, it really acts as a drag, I think, overall for silver.
Do you think that T-bills being at 5.5% are taking some of that demand away from gold?
Yeah, like it is for every asset, competition for stocks, et cetera. When you can get those kinds of returns in the supposed world's safest asset. Of course, that's not the real returns, but nothing else is right now. And you have the volatility in stocks, et cetera. So I think that's competing against everything. I think a lot of the big money out there that's shifting allocations toward safety, or has some portion of their portfolio allocated towards safety. Obviously, Treasuries takes a big part of that, if not most of it.
Yeah, I think especially for those investors overseas.
Yeah.
Because, that's one drawback to being an American right now is your expenses are denominated in dollars. For people like me, as an example, where my expenses are denominated in Colombian pesos, the dollar has been a great store of value over the last, let's say, 2 years. It's gone up. It's appreciated against the peso far more than the local inflation rate. And you look at the Japanese yen, you look at what's going on with China, a lot of currencies within the DXY basket, but also outside. For those investors, excuse me, that they're getting a great return just by holding treasuries because their currency is depreciating. Their expenses are denominated in other currency. So the dollar's going up plus a 5.5% yield. So I think for American investors, they've got to understand that component of it. And unfortunately for them, there's no other asset that like a treasury bond that they can buy that's where the FX is going in their favor.
Yeah, as a great financial guru, Albert Einstein once said, it's all relative.
Yeah.
So, people look at the strength of the dollar and they say, look at the dollar index, and the dollar's so strong, that's what's driving gold down. I don't think so. I think that the gold doesn't really care where the dollar index goes, and and obviously vice versa. I think they're both being driven together in opposite directions by the same stimuli, and that basically being Fed policy. Fed policy drives everything. It drives other central bank policy. It drives all the markets. Everything's fed and driven by those. And so if there's any indication that the Fed will have to have tighter money or raise rates, then the dollar index is going to go up relative to other currencies because it is a relative index. Dollar index is going to go up, and gold commensurately is going to go down, and vice versa. So, the important thing for people to remember, I believe, is that, again, everything's driven by central bank policy. All these supposed inverse correlations or contracyclical assets, all those correlations have shifted toward one over time, but most especially since the great financial crisis. Everything is what whispers we're hearing, or how we're reading the tea leaves toward future Fed policy, and then bets on that. That's what drives the markets right now.
So what are your overall views on the dollar? And I want to compartmentalize that because I think people make the mistake of just saying, the dollar's going down. Well, okay, against what though?
Right.
So you've got to say, okay, is that goods and services in the United States, or is that against the Japanese yen, or is that against XYZ other currency? So what are your views there around the dollar? And then I think we need to specify a time frame over the next maybe 6 months or a year.
Yeah, I think it will trend toward weakening because the Fed will lead the other central banks on the downside of this rate cycle.
Okay.
So that's the big bet now. That's why we saw that initial burst downward to just below 100 recently in the dollar index. That was essentially a bet that the Fed was pausing. And again, a recognition that the next big thing will be the bottom of that rate hike cycle. So over that 6 months to a year time frame, I think the trend will be lower for the dollar index and lower versus gold, because gold is one of those bets toward easier money and the repercussions thereof. If the Fed has to cut rates before it gets inflation down to 2%, and I don't know that, I'm doubtful that it will be able to get very close to 2% over the long term. But if they're forced to start lowering rates before they get there, that really is an admission of failure. And I think gold's the play when you see central banks being unable to manage things like they wish.
Yeah, I think that's a possibility, but my base case is if they have to drop rates quickly, like they did, let's say 2020, where they come out with an emergency meeting and they, I think back then they said we're going from 1% down to 0. So let's say they say, the stuff's hitting the fan, so we're going to have to drop from 5.5 down to 4, and then from 4 down to 3 or something like that. I think that is likely an environment where they're not too worried about inflation. I think that's like 2009. Remember, I think it was like Q1 or Q2 of 2009, where we actually had deflation, where prices act not just disinflation, but flat out deflation. But then, of course, you go right back into that next wave where prices go right back up to where they were and continue. I think they went higher in 2010, 2011. But that's kind of how I would see it playing out. Is they have, because they're dropping, means the environment is disinflationary until you get that next wave, which, to your point, because of the diminishing returns, especially on the fiscal side, I think is going to have to be much larger even than it was in 2020, and that's what takes you that next wave. I see it very similar to the 1940s.
Yeah. And again, why would they have to drop rates that low? And if it is something that it represents liquidity vacuum and or a flight to safety, you could see gold and the dollar index both gain ground at the same time. That's one caveat when they can trade together, is when there's a flight to safety. They're both viewed globally as safe havens. So that could happen. And then again, one of the things we try to figure out and plot the way forward, but one of the paths forward that it's hard to explain or predict is what happens when the Fed just loses control. Is that possible? Can they control rates just by really turning on the printing presses? But what if the market starts to demand higher rates for that risk profile of Treasuries and the US dollar? That's a scenario that can come from, a lot of different ways, a lot of different places. But what happens there? I think in that kind of a scenario where you have higher market forcing higher rates, you also have demand for gold because it reflects that kind of a crisis of confidence in the financial system.
Yeah, that's more of my longer term view.
Yeah.
Because the 10 years trading at 100 basis points under Fed funds. And that alone tells you there's a hell of a lot of demand for the entire curve right now.
Yeah.
How long that will last, I don't know, because you make a great point. A lot of others, like our good friend Luke Groman and Lynn Alden, make the same point that over the long term, where is this balance sheet capacity going to come from? Especially if they're running these $1 trillion deficits. And let's remember, every single time they go through a quote unquote crisis, they do all of this fiscal, but the deficits never, ever, ever go back down to where they were before. They come down, but they set kind of that new high water mark. You know what I mean? Like
Yeah.
they come down, but they don't go back down to where they were before. They're much, much higher. So let's just assume after this next, crisis, if you want to call it that, moving into maybe the end of 2024, now all of a sudden into 2025, we're running $2-3 trillion deficits. I see how there's plenty of demand right now, and I think that demand can last a lot longer than people think. But you have to wonder, there's not limitless balance sheet capacity.
No, there isn't. And even the official deficit is a misnomer, because you can have $1 trillion deficit, and then you look at the amount over that fiscal year that
Yeah.
the debt increased, and it increased 2 trillion. And it's like,
Yeah.
what?
Yeah.
Where did that come from?
I
So
did that. I did videos on that. Yeah.
Yeah, there's off balance sheet that's not even included in that, and that can be 500 billion alone. Right now, we're at essentially a run rate, maybe not net, well, definitely not net, but a run rate on a gross basis of about $1 trillion a year just in interest in the federal debt. I did a presentation at Rick Rule's conference in the end of July, and I took my last presentation and edited it. And I've got a slide in there on, that great debt clock where the federal debt is. And I had done it 4 months, that same presentation, or closely to it. I don't give the same presentation every time, but close to it. Anyway, I had that, and I looked at it 4 months earlier. The federal debt was a full $1 trillion lower than it was from April to July. It gained $1 trillion in the federal debt. They were talking about a $1.5 trillion deficit for, I believe that was the number predicted for this fiscal year. Halfway through the fiscal year, they're at 1.1.
Yeah. Right.
So, we're talking about close to $2 trillion deficit for this fiscal year, close to $1 trillion in interest on the federal debt, plus another $400 or $500 billion in off-balance sheet expenses. So we could be, 2.5, 3 or more trillion dollars added to the federal debt this year.
Yeah. When I try to play devil's advocate with myself, Brien, I go back and I look at the end of 2019, and I just did a video on this, so I think these numbers are correct, but I don't have a chart in front of me. The debt, the national debt, has increased by right around $10 trillion just since COVID. If you would have told me, because I think it's like 32, 33 right now, and in 2019 is about 23. Now, not the debt to GDP, but just the outstanding nominal debt. So if you would have told me that they would increase by 10 trillion over the next 3 years, I would say the same thing. I would be wondering where that balance sheet capacity comes from. Now, I'm not saying this is right or wrong. This is just always the internal debate that I have in my own mind. You know what I mean?
Yeah.
When I'm trying to say, okay, what's going to happen? Well, here's an argument for this. Here's an argument for that. And then I look at Japan, and then, most of the balance sheet capacity there came from their central bank, which you would think the release valve would be the yen, and to a degree it was, but not to the extent which you would have assumed.
Yeah,
that's always the debate that I have going on in my own mind.
Yeah, what is Japan? Why is Japan?
Yeah.
Why is it so many?
And
I've never found a good answer to that, frankly. But as far as the balance sheet capacity, one of the rough measures I used for years was that for every 8-year term of a president, or 8-year terms of, even if it's 2 4-year terms of 2 different presidents, the federal debt has doubled. So when Trump came in, and I said, well, Trump serves 8 years, it seems crazy, and I think this may be where the trend breaks down. But when at the end of that 8-year term, the federal debt could be $40 trillion, and it just seemed stupid to say at the time. We're on track for that right now. We really are, combining the 4 years of Trump and the 4 years of Biden. We're at 36 and change right now, and there's some time left. So, and Biden doesn't seem, and the administration doesn't seem to be restrained in any way. So Yeah. At what point does it just become so stupid, so silly, so incredible that, you know, people start to say, well, we're going to have, even the general public realizes what you and I and your listeners realize, that every few years, we're getting these big crises and they just throw money out there and money gets cheap as hell. And when that gets anchored in the public consciousness, the broad public consciousness, they're going to start saying, well, number one, spend like there's no tomorrow,
Yeah.
take on as much debt as you can, and try to protect yourself. But we are not going to give the dollar or any other fiat currency any respect. When that happens, things get out of control. And that's when I think the end game happens, that reset where they have to instantly uh, regain credibility somehow.
Yeah, you know, it reminds me of one of the first interviews I did with Luke Groman. And this was when I first started doing interviews back in 2020. And I don't remember when it was in 2020, but I remember the Fed's balance sheet was right around like 4.5 trillion, something like that.
Yeah.
And he and I were talking, and we were saying this jokingly. We're like, oh yeah, man, the Fed's balance sheet could go to 10 trillion.
Yeah.
Like, you know, that's so outrageous, but we'll just go ahead and throw it out there.
Yeah.
And sure enough, you know, the Fed's balance sheet gets up to 9 trillion. So we were off by a whopping trillion, but you know, who knows where it goes in the future. May get there pretty soon.
But, you know, it's kind of an example, looking again at the bigger picture, that none of this crap is normal. You know, you
Yeah.
get the talking heads on CNBC and the like, and they start talking about, you know, will the Fed do this, and the interest rates at zero and negative yielding sovereign debt. Um, you know, money just deposited by keystroke into people's accounts. If you would have gone on CNBC, you know, in 2007 or early 2008 and predicted any of this stuff,
Yeah.
they would have put the tinfoil hat on you and hauled you off stage, like they did for Peter Schiff for actually saying that. But you know, they would have just labeled you an absolute lunatic. And now we're talking about it like it's, you know, situation normal. But it isn't. None of this is the way it should happen. And if you look at it from that standpoint, you have to realize that this is a trend, and you know, we're in the end game, and that doesn't mean it's going to happen in 2 months to 2 years. It may take 20 years, the way things work. But the water is circling around the drain right now. Things seem to be happening more quickly and you know, more substantially. Um, Whatever lies ahead, you just have to get down to your foundational principles in asset allocations and make sure you're covered for those.
Yeah, totally agree. I think that's a great way to think about it is, you know, when you're draining the tub, you can't see the water go down.
Yeah.
But when it gets to the drain, then you see it happen very, very quickly, then kind of all at once. And then the water's poof, it's gone. And that's probably, that's a great visual as to why, you know, it's always good to have some gold. And I would even argue physical gold, just because, I mean, we haven't talked about it, but when you throw in like a central bank digital currency, I think that's a matter of when, not if.
Yeah.
I think it's pretty, you know, we talk about the price and where it's going and cheap and expensive and whatnot, but I think the best argument for holding gold or Bitcoin right now is just to have purchasing power outside of the system.
Absolutely. It's you know, it's freedom, it's independence in physical form. And you know, history teaches us that. And on central bank digital currencies, I know you share my view, but that's, you know, that's the four horsemen of the apocalypse coming in.
Yeah.
That is the ultimate trend, because government always seeks more power, and that's one of the next big steps. And the only way to prevent that, I think, I'm not much for political advocacy or anything, but I think everybody should shout that down from the highest rooftops wherever they can, and make that an issue in political debates, et cetera, and demand that any representative you have take a position now for or against. And it just has to be stamped out, because they are going to try to do it. They are already trying to do it with FedNow and the like. and setting the stage for it. But that's the most dangerous thing I can see ahead, the most frightening thing I see ahead.
Yeah, when I first started my channel, Brien, back in 2019, I remember every single time I talked about a central bank digital currency, people would call me a tinfoil hatter.
Yeah,
They'd say, "Oh, you're a conspiracy theory. Oh, George, you're going too far. Oh, you're becoming Alex Jones. Unsubscribe." They do
yeah.
that, and then here we are, 2 or 3 years later, and it's just part of the mainstream, and everyone's like, "Oh yeah, CBDC. Of course, we're going to have one of those."
Like they say, we need some new conspiracy theories, right?
Yeah. Yeah, because I was just going to say that. I saw it on Twitter. Some guy said, "I need some new conspiracy theories because all the old ones have already come true."
Right. Yeah.
And
It,
it
it
seems
really
like
is.
that's happening. It seems like that's happening more and more, and a lot faster as well. That's like part of that same drain
Yeah.
example that you gave. It's like, especially since 2020 and COVID. My goodness gracious, all the conspiracies that you had back then pretty much have come true, whether it was lab leak or anything else. And it's the one, probably my biggest concern moving into 2024 is, and I'm convinced of this. I think this is I know there are no certainties, there are only probabilities, but I think this is one thing you can say with almost 100% certainty. And that's the authoritarians and the central planners, the politicians, are never going to let a crisis go to waste. Never.
No, they're not. That's their opening. That's their opportunity. Yeah.
Yeah. So that when I look at the inversion of the curve right now, or all these other metrics that you look at that are just screaming recession, that's kind of where my mind goes. It's, yes, we need to worry about the economy, the unemployment rate, et cetera, protecting our portfolios, but we need to also think about this through the lens of how are the central planners going to try to leverage this.
Yeah, and that's one of the great lessons of COVID, in the past emergencies, as you say. But I think particularly in COVID, it really exposed a lot of wannabe tyrants
Yeah.
out
Yep.
there, and as Doug Casey says, we didn't see that. COVID was a great example of censorship, in other words. But like Doug Casey famously said, he's all in favor of hate speech, because you want to know who was thinking, hate speechy things, who were the people who were saying that out there, and let these people self-identify. And of course, the other issue is anybody can label anything hate speech.
Yeah.
But,
I think I can't remember. I think I was in Mexico City, and I was down there with Doug.
Yeah.
And he went into that spiel on why he thinks hate speech is fantastic.
Yeah. Only Doug.
Poke, and be the antagonist.
Yeah.
And how he kind of speaks really slowly and he pauses. He's like, I love hate speech.
Yeah.
He goes, now and then people just need to know that you hate them. And that's good. And it's everyone in the crowd. They don't know whether to laugh. They don't know whether he's serious, or it's just quintessential classic Doug Casey.
Yeah, Doug, every year when he'd get off the stage at my conference, he'd come backstage and ask me, "How do you think I did?" I said, "Well, Doug, I think half the people love you and half the people hate you." And he would just say, "Great, right on the mark."
That's awesome. So, Brien, when's the next conference, buddy? When can we look forward to that? Who's going to be speaking, and kind of what's going on?
November 1st through the 4th. I have to say, George, you'll appreciate it, but it's the best lineup I think we've ever had. This will be our 49th year. And, we don't have we don't have a Margaret Thatcher and Ayn Rand, but
but you got a George Gammon. I mean, come on,
that's
Brien.
it. I'm supposed to say that, George, by the way. They're supposed to leave that for me. I was getting right there.
Oh, okay. I'm sorry. Don't steal your punchline.
Really the bench strength. We live in extraordinary times. I think much like the subversive investment newsletter industry of the 70s and 80s came out to explain those extraordinary times. I think we've got people out there like you and some of the people I'll mention in a second who are out there rising to the occasion, being brought out by these extraordinary events, and through social media, financial Twitter, and the like, are really some of the most dynamic thinkers out there today. I look at everybody I tried to get, and I think Luke Roman was the only one who couldn't because he had a conflict. But
Let me guess, his kid's baseball game.
Probably so.
It's always, he always tells me
that. I think that might have been it. I think
yeah,
that might have been it. Fall ball, I guess. But we have Matt Taibbi, who I think is
I didn't know that.
most important journalist of our generation right now, exposing everything going on with the Twitter files, government censorship, and he's a diehard liberal, and I think he's just but more of a classical liberal, I think, than anything else. But he's just tremendously important, and we're going to showcase him, by the way, on a panel with you. So you're going to have some fun there, I think.
Oh, that's very exciting. Yeah, I'm really looking forward to that. I didn't even realize he was going to be there.
Yeah, he's going to be there, and I've got some other people on that panel. I've got, and I'll tell you about them in a minute. We have Jim Rickards, we have Danielle DiMartino Booth, we have you, of course. We have a great speaker I just locked in, Konstantin Kizin. Not a lot of people know who this guy is, but I think he's one of the more important and entertaining at the same time thinkers out there. It's Kisin. Go watch the video he has pinned on his Twitter profile, and you'll see why. And I've got him speaking. You're actually going to be on the geopolitical panel with him as well, and Matt Taibbi. We've got Rick Rule, we've got Dominic Frisby, we've got Brent Johnson, Lynn Alden. We've got in person this year, which
that's exciting. That'll be fun to see Lynn.
No insult to you, George. I've complimented you on this before, but Lynn, I think, is the best out there. I think she's the smartest person.
Completely agree.
And Dave Collum, who's always a hoot. Peter Bookvar, James Stack, Peter Schiff, Jim Arurio.
Oh, Schiff is going to be there?
I'm sorry?
Schiff is going to be there this year?
Yeah, we got Schiff back.
Oh, good.
He had some conflicts in the last couple of years, so Peter's going to be back. Jim Arurio was kind of, I guess he got off CNBC by mutual agreement. And Tabby Costa, who's brilliant, just signed up James Lavish. I don't know if you know who he is, but he does an extraordinary job of explaining complex subjects in macroeconomics. I've been comparing him to you, by the way, so I think you'd really like to look into what he's doing. The real estate guys, Adrian Day, Adam Taggart, a bunch of the top names in the mining industry, newsletter writers, and really just dozens more. It goes on and on. But it is, one of the, I think this is the best lineup we have ever had. And you know how it is, at this event, and how our speakers mingle with the crowd and everything. It's just an extraordinary environment to be in. Yeah,
I can't wait. I mean, you've got all my buddies. All my buddies are going. It's gonna be like a party.
Birds of a feather.
Yeah. So where can people get tickets, Brien?
www.neworleansconference.com. I see the link popping up as we speak.
Yeah, Josh, can you put that in the chat for us? Yeah, he'll put that in the chat.
neworleansconference.com.
Yeah, there it is. There it's in the chat. We'll put that in the description below. All right, Brien. Well, I appreciate your insights, buddy. It's good to talk to a gold guy, kind of clear my head on some of those ideas, and I can't wait to see you in November.
Me too, George. We look forward to seeing you. We are going to give you lots of stage time, and I know you've got more standing ovations in your future here. So looking forward to it.
All right. Have a good one, buddy.
Thanks.